Welcome back to Build Wealth Now News. I'm your host, Billy Bob, and sitting across from me, as always, is our brilliant co-host and market analyst, Sarah. Today, we are diving into a fascinating turnaround story. It's a company that went public, got absolutely hammered by the market, but is now quietly transforming into a cash flow machine. We're talking about Riskified, ticker symbol RSKD. Sarah, let's kick things off. For our viewers who might not know, what exactly is the business Riskified is in?
Thanks, Billy Bob. At its core, Riskified is an e-commerce fraud prevention and risk intelligence platform. When you buy something online, Riskified's proprietary machine learning models analyze that transaction in milliseconds. They essentially guarantee approved orders against chargebacks. They make money by charging merchants a small percentage of the gross merchandise volume, GMV, of the transactions they approve. It's highly sticky recurring revenue model because once a merchant integrates Riskified into their checkout flow, ripping it out is a massive operational headache.
So they are the bouncers at the door of the internet's checkout line, making sure the people buying stuff are actually who they say they are. That brings us to our second point. Where is Riskified in its business phase? Are they still burning cash to grow, or have they matured?
They have officially entered phase 5. Capital return. This is a huge milestone. In Q4 2025, Riskified posted its very first GAAP profitable quarter. They've transitioned from a hyper-growth, cash-burning startup into a mature, cash-generative business. Because they are now generating real free cash flow, they've initiated an aggressive share repurchase program, buying back $105.9 million worth of stock in 2025 alone, with a new $75 million program authorized.
That's music to my ears. Buying back shares when the stock is cheap. But let's talk about competition. What does their moat analysis look like? Do they have a durable competitive advantage?
We assess their moat as narrow, and it's widening. Their primary moat sources are switching costs and intangible assets. As I mentioned, integrating them into a checkout flow is mission critical. Their net dollar retention is an incredibly sticky 105%, meaning existing merchants are processing more volume, not leaving. Furthermore, their intangible asset is massive. They have processed over $800 billion in cumulative GMV. That proprietary data set trains their AI models to be more accurate than newer entrants, creating a data network effect. The more merchants they have, the smarter their fraud detection gets.
An $800 billion data advantage is nothing to sneeze at. But they are in phase 5 now, so top-line growth must be slowing. What are their primary growth drivers?
Exactly. Revenue growth has normalized to the mid-single digits. Their primary growth driver is existing customer expansion. That 105% net dollar retention proves that their current clients are buying more. They are also cross-selling new products like payment optimization and identity verification to increase their wallet share. Secondary drivers include geographic expansion. They are adding new logos across all global regions, and brand building through their Riskified Ascend events. They aren't relying on new customer acquisition alone. They are maximizing the value of the customers they already have.
Let's look under the hood at the business key financial metrics. How healthy is the balance sheet?
It's a fortress, Billy Bob. Riskified is entirely debt-free and sitting on $297.6 million in cash. In fiscal year 2025, they generated $33.1 million in free cash flow and are guiding for $40 million in 2026. Their cash conversion is exceptional because they have zero debt, they have zero interest rate risk, and that massive cash pile is exactly what's funding their aggressive share buybacks.
Zero debt and a mountain of cash. But every stock has its skeletons. What does the risk analysis tell us? What could go wrong?
The overall risk is medium. The biggest structural risk is their business model. Because they guarantee approved orders, they have to pay out chargebacks. In fiscal year 2025, these merchant payouts accounted for 48% of their revenue, which caps their gross margins around 50 to 52%. If fraud rates spike, their margins compress. Secondly, they face intense competition from AI-native startups like Xeon. Finally, from a sentiment perspective, co-founder Asaf Feldman recently notified the intention to sell 263,000 shares. While insiders sell for many reasons, it's a bearish signal we have to monitor.
Good catch on the insider selling. So given all this, how should we actually value this stock? What valuation metrics matter here?
Because they are in phase 5 with single-digit revenue growth, we completely ignore price to sales, P/S. The market doesn't care about top-line growth anymore. It cares about earnings. Our primary metric is the forward price to earnings, P/E, which sits at a very reasonable 19.22 times, right in line with the broader software industry. Our secondary metric is price to free cash flow, P/FCF, because their cash generation is what's funding those massive buybacks.
Let's bring it to the present day. What is the price and sentiment analysis telling us?
The stock has stabilized beautifully. It's currently trading at $5.26, which is near the top of its 52-week range of $3.70 to $5.68. Over the last 12 months, sentiment has shifted dramatically from pessimism over continuous losses to cautious optimism. The market is re-rating RSKD from a cash burner to a value and cash flow play. The bulls love the $40 million FCF guidance and the buybacks. The bears are worried about the slow 5 to 7% revenue growth and the insider selling.
That brings us to our final analytical step. What are the analysts' price targets and the discounted cash flow DCF models saying? And Sarah, I want you to put on your Warren Buffett and Peter Lynch hats, and then your Chartered Market Technician CMT hat for our viewers.
Absolutely. Let's start with the data. According to simplywall.st, the DCF model values RSKD at $7.36, meaning the stock is currently trading at a massive 54.3% discount to its intrinsic fair value. Meanwhile, Zacks analysts see it as roughly 9.6% undervalued based on consensus targets, and they are projecting a massive 35% EPS growth for FY1 as operating leverage kicks in. Now, looking at this through the Peter Lynch and Warren Buffett perspective, Peter Lynch would love this busted IPO turnaround story. Management stopped the cash burn, focused on efficiency, and is now buying back their own cheap stock. Warren Buffett would absolutely love the fortress balance sheet, zero debt, and a 54% margin of safety. Furthermore, those high switching costs protect their 52% gross margins, giving him the sleep at night factor. But as a chartered market technician, CMT, I have to look at the chart. The stock is showing strong relative strength, trading near its 52-week high of $5.68. The trend is up. However, the divergence I'm watching is the insider selling. If the stock approaches $5.68 and fails to break out on high volume, it could mean the insiders are absorbing the buying pressure. Technically, we want to see a clean break above $5.68 to confirm the next leg up.
That is a fantastic breakdown. So, Sarah, the million-dollar question for our viewers tuning in right now is RSKD a buy, sell, hold, or do nothing? What should the viewer do?
Here is my verdict. It is a hold if you own it, and a buy on dips if you don't. Fundamentally, the stock is incredibly cheap, financially robust, and trading at a 54% discount to DCF. If you already own it, hold. The company is executing perfectly on profitability. And as the market realizes this isn't a dying business but a cash flow machine, multiple expansion is highly likely. If you don't own it, it's a great value play, but do nothing until we get a technical confirmation. Wait for a pullback to the $4.80 range to get a better entry, or wait for a high volume breakout above the $5.68 52-week high. Don't chase it right into the insider selling wall.
Hold for the owners. Buy the dip. Or wait for a breakout for the non-owners. A 54% discount to fair value with zero debt is a value investor's dream, but we always respect the technicals and the insider activity. Sarah, as always, fantastic insights. Viewers, make sure you hit that subscribe button, ring the bell, and as always, build wealth now. We'll see you next time. Build Wealth Now News is dedicated to research the businesses behind the stock names. Our research are done with artificial intelligence assistance using the best practices in the industry. Please note that investing carries its own risk and you should do your own research before committing any stock to your own portfolio. This conversation is for educational and entertainment purposes only.